Okay, so welcome to our webinar. Today's topic is today's Magnificent Seven. So some of you might be thinking, what's the title of the story? Why do we have this title? So just a show of hands, there's a facility where you guys can put up your hands. How many of you on this webinar can remember the original movie called The Magnificent Seven, way back in the 60s? Okay, let me see how many hands are going up. Okay. One or two, three of you, or four of you. Okay, so most of you have never heard of this movie. Okay, some of you have. Okay, well, the idea of back in 1960, there was this American Western movie that starred Yul Brynner, Eli Wallach, Steve McQueen, Charles Bronson, Robert Vaughn, and obviously James Coburn. But the whole story revolved around the oppressed Mexican peasant village that assembled 7 gunfighters to help them defend their homes from a group of marauding bandits and their leader. So that is the Western as such. And some of you might know, or let me ask you this question. How many of you know that Hollywood's in the process of releasing an updated version of that movie this year? And obviously, even Hawk is going to be one of the stars in the movie. So the question is, why am I using that as an intro? So, an idea also, it's a bit of similarity. So, although the actors are different in the new movie, the characters and the story pretty much the same. Now, the same goes for fundamental analysis, and that's how I tie it up together. The importance, obviously, is the numbers do not change. That when you look at analyzing a company, remember, fundamental analysis basically is a foundation of solid investing. Now, you as an investor helps you, looking at fundamentals helps you understand the underlying health of the company, and you use various, call it financial documents, or you want to look at financial ratios, and that's you get it from the income statement, the balance sheet. I'm referring to the old income statement, the old balance sheet, but the earnings numbers and other indicators that help you determine what's the economic health of the company. And from these fundamentals, you as an investor would evaluate the company and see if it's undervalued or overvalued. So my main objective as an investor is to beat the market or outperform inflation, number one, but also to pick the winner. So it's not to do stock picking, yes, number one, but and I've got an 8-year-old son, and my philosophy always is if I can simplify the market and this is a quote from Peter Lynch, if you're prepared to invest in a company, then you ought to be able to explain why in simple language that a 5th grader could understand, and quickly enough so the 5th grader won't get bored. So this is how it all fits together, is the fundamentals don't really change, valuation techniques, and looking at risk and all those kind of things. Okay, so my objective today, we're going to go through very quickly. My objective today with this webinar, after this webinar, my objective is obviously to create awareness, to show you, those of you that don't know our website, the research tools available on our website that saves you a lot of time, and also the process, how to find the gold nuggets, the companies that give you the potential for growth. Yeah, but also to provide you as an investor various options. And we're going to look at 7 companies today. And the idea is for you to make better, well-informed decisions and ultimately have peace of mind in your portfolio. So the current situation I think for a lot of people, and it'll be on the next slide, is that there's a lot of uncertainty, there's a lot of volatility, and the people are begging the question, is there still value in the market? And we'll be addressing that question. So the ideal situation is obviously to think more of a longer term. Over long term, volatility is smoothed out. But as a value investor, the idea is to stick to your guns, and excuse the pun. Stick to your guns, stick to your knitting, and that's what it's all about. So let's get into it. What is the current situation? So what I've done is just a quick intro, is to get a quote from Brian McKnight. I want people to take a step back, take a deep breath, and actually look at something with a different perspective. And that's just my objective today, is to look at things with a different perspective, there is pockets of value in the market, but most people never do that. So we hurdle from day to day instead of looking at the big picture. So that's just a bit of an intro into the next slide. So here I've got the top 40 index, which is a barometer of all the top 40 large cap stocks. This is showing you the last 4 years, 5 years. You can see the market is a good little bull run for the last 3-4 years. And for the last, say, 2 years, we've been moving sideways, a bit of a consolidation period. But from a valuation point of view, this is the PE or the PE ratio of the top 40 index. We're trading at a 21. Okay. On average, we've been down to about 16, and we've been as low as 12. That's in the last 4 years. The lower the PE, the better. Price earnings multiple, and I'll explain that in more detail a bit later. The inverse of the price earnings multiple is the earnings yield. You can compare it loosely to a bank. What would you prefer, 8.5% returns on your money or 4.89? And that's where we're at the moment. So this just works inverse. And then obviously from a dividend point of view, the average dividend yield on the market at the moment is 2.81. This is looking at the top 40 index, the large cap stocks. The next 60 companies, we call that the mid caps. Very similarly, we've pulled back from those highs around about 19.5, 20, and we're pulling back. So whereas the top 40 index has moved sideways for the last 2 years, the mid caps have a nice little run this year. But I can see a bit of profit taking coming in, and then the price is falling back. And maybe we'll see this move out of mid caps into the large caps. Remember, a lot of the large caps are rand edge stocks and things like that. Okay. Let's get into another quote here from Prati. When you step away from doing something that you have always been doing, and then you return to it, you have a different perspective. So those of you who haven't looked at fundamentals for a while, this is where I'm using this quote. You get the desire and the will to strike at everything. So, yeah, that is just as an introduction to the current situation. So what is the ideal situation? So the ideal situation, obviously, and I always use Warren Buffett as an example. And I'm going to look at using, call it his secret formula, or basically his investment philosophy. So this is a quote, it's a combination, this is from his Berkshire Hathaway report. Warren Buffett and his partner, Charlie Munger, says, we select such investments on long-term basis, weighing the same factors that would be involved in the purchase of 100% of our operating business. What I mean by that, they look at favorable long-term economic characteristics and competent and honest management. And what's also important, this is from the value point of view, purchase price attractive when measured against the yardstick, and we'll use various yardsticks just now, of value to a private owner. And also very importantly, an industry in which we are familiar and whose long-term business characteristics we feel confident to judge. So something that you're getting involved is something you understand. So based on those 4-5 criteria, do we just take us out of the way here? We are full house now. We've reached our capacity. Okay. The other quote from Warren Buffett. When we own portions of outstanding businesses with outstanding management, our favorite holding period is forever. And as I was saying just now with being a value investor, and I think this is one of Warren Buffett's secrets. He's a long-term investor. He writes it all out. So how do we get there? On our website, on the PSC Wealth website, we've got a tool called the value filter, or the search function. So once you've logged in with your username and password, you click on research and you click on search button. And it, as a shortcut, we've got a little facility here with a default. It's called undervalued quality stocks. So yes, you can go and select each of these criteria. There's 3 different criteria. The more criteria you put on, the stricter it becomes. And that's based on 12 different financial criteria. As a starting point, and that's what I did in this example. I clicked on that button. What I'm looking for undervalued quality stocks. So yes, on the one hand, there might be these, you look at companies like Richmond. It's a great company. It's a good quality company, but it's not cheap. It's not undervalued. So let me just get out of the way again. So the idea is that in this criteria, we use a financial ratio called the PEG ratio, and I explained it just now. And that's our parameter between 35 and 75, and a quality rating above 70%. So if I click on that little button, by the way, that's what I want to focus on in the legend. I'm looking for shares that are color-coded green. So before I get into the list, I want to explain to you what we mean by the PEG ratio. So the PEG ratio basically is we're looking at two stocks, both on a P ratio of 15. They both seem cheap if you look at the average of the market at 20. But this company, stock number one, is growing its earnings by 30%. So you divide the PE by the growth factor and you get a PEG ratio of 50, which we consider is very, very cheap. Whereas stock number two is considered very expensive. If you take the 15 PE divided by the growth, it's only growing by 10%. It's got a PEG ratio of 150. Okay. If you look at the sector, for example, would be at 75, which is still, we believe, is offering value. So this is where the PEG ratio comes in. Instead of looking at PE ratios, we look at also the growth. So we bring in the growth into the formula. So we use a 5-year model. 3 years back, we forecast 2 years forward, and that's how the whole model is done for you. So that's on the one side of the coin. The other side of the coin, you don't only look at investment that's based on value, but also quality. And when I mean by quality, and this is a quote from Warren Buffett, we're not only looking for a fair company at a great price, we're looking at a great company at a fair price. So what is quality? When we look at quality, what are the characteristics of a good quality company? So first of all, we're looking for a company that's growing ahead of the market. So its products are there, its demand for its products, it's selling a profitable product, it's producing above average returns, earnings on your capital. So yeah, we talk about the magic of compounding. For every R1 invested, I want to get much more back. It's generating healthy cash generation. Looking for shareholders, it's paying out a healthy dividend, and it's obviously got manageable debt levels. So that's very broadly what we consider as a quality company. Going into more detail, there's various financial ratios we would use to help us quantify the quality rating. So first of all, we look at profitability. So as long as the turnover is way above inflation, that's number one. The normalized operating margins are quite high relative to the sector. We'll talk about operating margins a bit later. High above return on equity, and we'll talk about those two. And then the average return or tangible net asset value, so way above the average. So that's where we look at profitability. Then we also look at the quality of reported earnings, and this is where I look at cash flow. So we're looking at, is this company able to convert its profits into cash or convert its earnings into cash? And what's very important, we don't look at any companies less than 3 years. So the company has been around for at least 3 year periods, reporting periods, to be considered. Then we look at dividend policies, and we look at the amount of dividends paid out as a percentage of its earnings. And the average of the market is about a third. So the more the better, but obviously we're looking at sustainability. We look at interest cover, and that's also we're looking at, you don't want to go into a company that's going to go bankrupt. So interest cover together with the cash flow, very, very important. Okay, so let me just turn this off. Sorry, I realized my webcam was still on. Okay, I hope that speeds things up a bit. So a little message popped up here. Sorry guys, I'm going to see if there's... Okay. Looks like everything's okay. Okay, sorry about that, guys. I thought the webcam was off. Okay, so hopefully you guys can hear me clearly now. Yeah, and then obviously when we look at these ratios, we take all these ratios together and then we weigh them and we mark it out of 100. The higher the value, the better the quality company. So in our criteria, we're looking for companies that have a weighting of more than 70. Okay, so I did a scan using that undervalued stocks, and out of the 450 listed companies on the market, there's about 16 companies that come out that we consider at the moment still undervalued. And out of that, I've chosen my 7 stocks, and these are the ones I'm looking at. Today I'm going to look at Comair, Grindrod, MTN, Raynet, Sun International, Value, and Wilson Bailey. Now, I know that some of you are going to say, whoa, Sean, you know what's happening with Comair, you know what's happening with MTN, etc. Yes, I'm aware of them, and we'll be discussing the cloud hanging over those stocks, okay, and where the opportunity lies. So let's get into the nitty-gritties. Let's talk about the 7 companies. So first of all, look at Comair. And by the way, you scan the market, and the idea is to create a watch list. And I've always believed that the watch list is a big time saver. Once I create my own watch list, you can see I've got 3 different watch lists. to show you price movement. So yes, shows you the market action intraday, but there's a little button here called View as Investor. Obviously, I'm looking at View as Investor already. So instead of looking at price movement, I'm looking at those 12 different criteria I showed you just now. And from there, I can make a decision what shares to buy and things like that. This is a screenshot I did this morning, just being updated. But they're all undervalued stocks, all green, based on that legend. But that's how I got to this watch list. So let's talk about Comair. So first of all, some of you might know Comair. We talk about the green plays. We talk about Kulula. But also remember, it operates British Airways. And Comair is a major player, obviously, in the local market. But the franchise, the British Airways franchise, has just recently avoided having its domestic flights suspended by the Air Services Licensing Council. Now, the council is arguing that Comair exceeded its 25% foreign shareholding limit as a domestic airline. And Comair obviously is disputing this fact and saying that they're compliant with regulations. They're saying that Comair is 11.5% owned by British Airways, number one. That's according to the 2015 the annual report. But also its biggest shareholder is Bidvest, which owns 27%, followed by Allan Gray, 12.9%. But and this is and this is from the company analysis page. What I always look at pros and cons, the concerns and what we like. So yes, they are operating within a challenging trading environment, and the competition is intensifying. And the big worrying factor here is obviously the higher oil price. I see the oil price is running up this morning, and the other side of the coin is the weaker rand. So those are the two biggest challenges facing Comair, which is out of management control. That's number one. And number two is obviously as price goes up, inflation goes up, interest rates go up, that also put a damper on consumer spending. And bottom line, there's going to a bit of a price war, and hence margins under pressure. So those are some of the concerns that I think most of us would be aware of. But saying that, it's a well-run operation. It's got strong brands. It's got a decent return on equity. Return on equity, yes, 10.1. It was at 27, but I'm talking about historic. They'll get there again. They have strong cash generation. You know, anything above 0.75 consistently, we say that's very good. But you can see here, the cash flow as a ratio of earnings, very, very good. What I like about this company also, they're diversifying their operations by exploring travel-related opportunities, and I think that's going to become bigger and bigger with them down the line. But saying that, we still believe that the share offers value, trading at a historic P of 9.7 times, and at a 10% discount to price NAV. So yes, it's undervalued, number one, and number two, it's a quality stock. So our recommendation, this is based on the results until December. It came out, I think it was February, March. We're still highlighting it as a speculative buy for investors. But we like Comair in that space. So add it to your watch list. And by the way, you can also add in the technicals. If you bring in the technical charts and look at the trend is bearish. Yes, number one, because it's trading below its 50 and 20-day moving average. Secondly, it's underperforming relative to the market if you bring in relative strength. So, but these are the stocks you want to look at from a contrarian point of view. When everyone else is selling them, you want to be buying it. And by the way, of all these stocks, my view is 5 years' time that I've made at least 50%. Worst case scenario, or the best case scenario, in 3 years' time, I've made my 50% return on the share. Okay. Second stock I want to look at is Grindrod, logistics company. It's more shipping and that kind of stuff. We'll talk about another logistics company just now called Value. Pros, or the concerns, drought obviously affecting its agricultural business. The biggest thing is declining dry shipping rates and oversupplied tonnage on that side. And obviously it all comes from the low commodity prices impacting on volumes at the terminals, which is bay terminals and things like that. The group operations is very cyclical, so it's a cyclical stock. Those of you who maybe want to trade it, nice little stock to take advantage of, buy low, sell high. But saying that, yes, these guys' operating profits and margins are depressed. And bit of a rand stock, they are sensitive to the rand-dollar exchange rate, number one, and number two, obviously the shipping rates. And these two factors do fluctuate significantly, and again, beyond management's control. So those are the things that you must be aware of, but we still like the company in the sense that we believe it's poised to improve profit a lot from its current base. We also believe there's value. It's trading at a 50% discount to its tangible net asset value. But because of the difficult trading conditions, again, we're highlighting this for a speculative investor, as a buy investor. As I say, there are pockets of value in the market, but there are risks. Okay, be aware of that. The third company is MTN, and yes, we all know about the Nigeria fine. In this week's newspaper, I saw that they suspended talks around that. It's gone back to the parliament. And I saw today's newspaper again, another article about MTN, where they're calling for new management. Okay. So yes, there's concerns about growing regulatory pressures in Nigeria, Uganda. There's a lot of uncertainty, yes. There's macroeconomic conditions here in South Africa is a factor, and obviously a currency weakness in other countries. But saying that, MTN is still a quality company. It offers a healthy cash generation. Look at that cash generation here. Healthy cash generation. It still has high margins. Look at those margins, 25%. Above average return on equity. Okay, not in this scenario, but that's the average. So it is below average return on equity. We believe to go back there. But we also believe that it looks fairly valued. It's trading on a PE of 19.3 and about 80% on its NAV. But look at its dividend yield, 9.1% dividend yield. Again, a speculative buy for the investors. Okay. The fourth company is Raynet. Now, this is not in that original scan I did, but we added it in because we think there's opportunity in the sense that this is more of a holding investment company. It's a cheap entry into British American tobacco. So yes, 70% of its business is, or 72% of its business is British American tobacco, or it's holding in American tobacco. That's contributed to earnings. It owns about 4% of the listed shares. So what's nice about this company, and this was we estimated the share was trading at a 30% discount when the share price was at 29.40. The price has gone up since then, trading at about a 20% discount to its net asset value of 42%, 42 rand 30 cents. So there's still opportunities there, we believe. But also, despite that having a hold recommendation, we believe it's a buy to get into bats. And by the way, this is Anton Jan Rupert's little company. What I find interesting about these guys, they recently got involved with gold. Where I say that 72% of the profits come from British American tobacco. But they also just recently got involved with the largest physically backed ETF in the world, which is the Gold Spider. They hold 230,000 shares with a market value of about 22 million euro. So it's interesting that they call it a bit of a hedge there. But also I find, those are the two listed elements to Raynet. And I find interesting is that they've got an unlisted portion which contributes 16% to the NAV, which is the Pension Corporation. They own 43% of Pension Corporation. There's a move from, remember the good old days we used to have what they call defined benefit funds. A lot of companies want to move this off their balance sheet. Now, Pension Corporation buys it from them, obviously at a discounted price. But what's interesting to note is that Pension Corp has about 14 billion pounds of assets under management and has over 100,000 pension fund members. So it's interesting there where these guys are going. So it's not only the story around bats, is around that pension funds and as well as the gold. But we believe there's an opportunity with the discount on against the NAV. The fifth company is Sun International. Some of you might know what's happening there. There's pros and cons. If you compare Sun International to Tsogo-san, where Sun International is getting rid of properties to finance the expansion. They're doing a big project in Mainland. That license there, they want to focus on that, where Tsogo is buying up assets. So it's interesting to see this mixture between the two of them. I like Sun International. Yes, there are pros and cons. There's pressure on the casino business. The hotel business is doing okay. Well, we're plodding along there. But we are concerned about the high level of gearing. And Sun International's always used gearing to expand their business. And that's why they're going to get rid of some of their properties now to get rid of the gearing. This is how they always operated. But they always had good cash flow. And that's why these guys have always been involved in that kind of business model. We are concerned about the regulatory environment in the gaming industry, but that's part of the game. Sun International has a solid track record, good margins. Look at those margins, operating margins, 18.3%. It is attractive. It's a historical PE ratio of 10.8, and yes, 3.7 NAV. But again, we're highlighting speculative buy here. I believe going forward, these guys are also coming off a low base. There's a lot of projects they haven't really kicked off yet, but I believe there's opportunities there. And number 6 is another logistics company, Value. Now, these guys are more involved with truck and rental services. They do a lot in the retail space. The biggest worry there is declining retail volumes. That is obviously affecting the business. And as interest rates go up, will affect credit spending, and obviously affect the client base, the client exposure to the retailers. Volatile exchange rate and growth rates also concerned. And we can talk about margins, but these guys have a high fixed cost base, and that's also a bit of a concern. So they haven't got much to play around when it comes to margins. You can see 1% drop in operating margins there, which translates into losses as such. But traditionally, it's got good operating margins, good cash generation, high return on equity. But it's trading at a PE of 8.9. As I say, it offers some value there, and it's trading at a 30% discounted price NAV. Quality company that we believe is opportunity. So this is more a buy for a longer-term investor. Great little company. Just be aware that sometimes this share doesn't really trade. It's very liquid. So just be aware of that side. And the last company in the construction space, out of all of them, the one I like is Wilson Bailey. I've always had Wilson Bailey in my portfolio for a long time. So yes, that's my disclaimer. I do own the stock. We are concerned about the decrease in the order book. These guys are big players in the building market. They have a big offshore element. 56% of the business comes from Australia. So yeah, it's a great little company. These guys, you're always going to say, what about the competition? These guys haven't even made set funds aside. They said they weren't guilty. So yeah, there's pros and cons always with that story. Two sides of the corner of the story as such. But at this point in time, the operating margins are below long-term average. Again, you can see it's very, very tight. And the big thing about construction companies, and this is always been aware of, it's very cyclical, number one. And number two, there's that contract risk. We've seen it with Murray Roberts. We've seen what happened in Dubai a few years ago, with the whole Gauteng train, the tunnel. You estimate the jobs could be 100 million. Next minute, 150 million. That additional 50 million comes out of your pocket as a company. But saying that, it's trading on a historical PE of 11. 10.8, so we still think there's value there, and it's trading roughly about 70% premium to NAV. Dividend yield, about the average 3%. We suggest those of you that do hold it still to carry on holding. But I believe, and this is from a technical point of view, the share has come off. It's a bit of a moving sideways, so there's been a bit of a recovery in the stock. So I like the company. So guys, I know you guys might have some questions. On our research platform, I want to highlight, first of all, create those 3 watch lists and split them up: financial shares, industrial shares, and mining resources. And from there, you can link through to the share info page. And on the share info page, click on the research tab, takes you through the company analysis. But use the value and the quality filter to scan the market. So both these tools help you save time. Okay. And then also you can look at our recommendations, our top 10 large cap stocks, top 10 small caps, and there's also undervalued quality stocks. So those of you as a starting point, don't know what to look at, maybe look at our recommendations. And then also on the equity platform, those of you that don't have account with PSG yet, now we do offer direct market access. You can place your orders after hours, and you've got a facility where you get price alerts and stop orders. Our brokerage works on a sliding scale. 0.9% for the first 25,000, middle of 98 Rand, and we have a monthly admin fee. So that's what, in this context today, if you look at our equity platform, you can also play around on our simulator, how the platform works, but also you have access to research tools that won't cost you anything. Okay. There's a quote from Warren Buffett before I handle any questions. Long ago, Benjamin Graham taught me, remember it was his mentor, taught me that price is what you pay, and value is what you get. Whether we're talking about stocks or stocks, I like to buy quality merchandise when it's marked down. Now, all these stocks, except for maybe RandNet, which has had a good little bull run, and Wilson Bailey, all these stocks have had been knocked down. The market has sold them off. I believe there's opportunities, but they're still quality stocks, and that's what I want to highlight it for you today. Okay, let's see what questions you guys have. Cool. Whoops. Sorry. Get back there again. Questions. Of the okay, Francois, debt equity ratio of 504%. These guys are geared up. They use leverage. They use their properties to borrow against their properties to buy more properties. So their debt is 5 times more than their equity. That's their debt equity ratio. Imagine you as a property owner. You buy a property, put down 10% deposit, and you want to buy a R1 million house, put 100,000 Rand down. You borrow the other 900,000 from the bank. The debt equity ratio is 90 to 10. When it gets to a stage where it's 50-50, maybe you as a property owner can renegotiate with the property. Now with Sun International, their business model is to use gearing to expand. That's how they've always done it. But they are changing now. They're selling some of their properties off, properties rather, to bring that debt ratio down. Okay, so Francis, I hope that answers your question. How does one interpret a negative HEPS? Yeah, Eleanor, obviously it's loss making. What you want to see, is it a once-off situation? Will it be sustainable? And those are the kind of things you're going into consideration. Usually with HEPS, it's headline earnings per share. They've sold off something that's not really usually part of the business. They might have sold it off as a loss, and that could have been impacted on that. I don't know which specific stock you're referring to, but that's where we talk about a negative headline earnings per share. Here's a long question here from Shaima. Of the 7 shares, to me, only RandNet seems to be the best buy at this time. How do you think this will perform over the next year? Difficult one. Depends. It all depends on a good question. It all depends on what happens with British American Tobacco, and they're trading very, very close to their all-time high. That's number one. And number two is that we're saying hold on British American Tobacco. Is it cheap or expensive? And we've compared it against European consumer stocks, the food stocks, and we're saying that it is still cheap. So when I say compare it against food stocks, remember it's defensive. Cigarettes, people always will smoke. Food, people always need to eat. And that's the argument. So in my opinion, at this point in time, it's had a good run. So we might have a consolidation. We might move a bit sideways. We might see some pullback on some profit taking, but from there I anticipate to go up again. Okay. You have not okay, Jan, I've not referred to market cap. Most of these stocks are on the top 100 anyway, Jan. So it'd be either mid caps or large caps. Okay. Yes, this presentation will be on YouTube a bit later. It'll be on Friday, but I'll be sending the recording anyway. Good question here from Heinrich. What impact will the credit downgrade have on the market, and which sectors will be least and most affected? What action should an investor take? So first of all, I think one of the most important things we can learn as an investor is the concept of discounting. The market has discounted or anticipated a downgrade already, and I think it's reflected in the exchange rate. The rand is weaker already. The big thing there, obviously, if we do get a downgrade from Moody's or from the ratings agencies, the big thing is we might have some more funds getting out of the country. Remember, the institutions have a mandate to invest in quality stocks and quality markets. So, but to a large extent, I think that's happened already. So you as an investor, and this is again where I believe being a value investor is that margin of safety. These stocks have been hammered already. You've got that margin of safety. I'll go defensive. You look at the food stocks, look at the medical companies, the healthcare companies, but they're not cheap. So it's difficult. I also look at these companies that we've highlighted already. The problem also with a downgrade is that from a borrowing point of view, a lot of the companies would borrow, and interest rates will go higher. So those are the implications. So I would stay clear of interest-sensitive companies that are borrowing. Be careful of banking stocks to a certain extent. Obviously, they've made allowances for bad debt, but if interest rates go up, there'll be more bad debts coming in on track. So I hope that answers your question, Heinrich. Here's a question from Kobus. Statement here from Ludovic. He's off to the beach. Thanks for the presentation. What is the best way to negate misleading PE ratios? As the example, currently high based on historical performance, although future prospects may be extremely negative. That's exactly why we use the PEG ratio. So bring in the growth factor. I think that's important. PEG ratios and price NAV, those kind of things. So look at our research tools on our website. PEG relative to return on equity, PEG relative to net asset value would negate some of those call it disadvantages around the PE ratio. Francis, what is a debt equity of negative 88.5%? These guys don't have debt. So when you see negative debt, they cash flow. Okay. Chris, unfortunately, I can't give you a view on the Aries. I haven't looked at it for a while, but I'll answer you by follow-up email. Good question, Dion. Why do I consider Rainet if they do not pay dividends? So, it's not a dividend play in this example. I'm looking at more the discount to NAV as a value play. So, hopefully that answers your question too. Okay, here's a question from Gary Rolfe. Can you do analysis presentation for international stocks? The challenge, Gary, with international stocks is getting access to information. So yes, I use Google Finance to get some of the ratios. I am spoiled with our website with the PEG and things like that. I use it. Some of you might, I know a lot of you on this website do use it. I use a program called VectorVest 7, and that combines fundamentals and technical together. So I have access to the South African market as well as the US markets. So that helps me with valuation. But the challenge is doing an analysis on those international stocks. It's such a big market. But we'll revisit that again in the future. What version of Metastock am I running? Rupert, I'm running, I think it's version 9, so I'm way behind. But it's suitable for my needs. It should work on Windows 7 anyway. So, Rupert, I hope that answers your question. Okay. Okay, so like those are all the questions. Thanks for the questions, guys. Thanks for participating. Just quickly, just to sum her up, if you want more information, go to our website, go look at our research tools, go play around with our trading platform, especially the simulator, understand how it works. But what I want you guys to get from this presentation today is the tools available for you. Value filter, the watch list, and company analysis. These are tools to help you save time. Doesn't still, you still need to get hold of the financials and go through the numbers, understand the company. And it goes back right to my statement right in the beginning. Behind every stock is a company. Find out what it's doing. Okay, what is its story? So yeah, so those are my magnificent 7 that I want to highlight today. Hope you found benefit out of this presentation. As I say, go to our website, go look at the stockbroking website. There's a link through to the research tools, explains what we have on offer. Next week, we're discussing how much do you need to retire, how much is enough. The week after that, we're talking about currency futures. The week after that, we're talking about trading index futures. And in the middle of June, we're talking about how to hedge using single stock futures. But I hope you've enjoyed today's presentation. There's my contact details. And anything I've highlighted today, again, this is not for you to rush out and go buy the shares blindly. This is a disclaimer. It's for education purposes. So there are risks involved. Be aware of those risks. But remember, my whole objective of this presentation is for education. I'm not a financial advisor, so I'm not eliciting any business from this presentation. But guys, thanks a lot for being on this webinar. I hope you've enjoyed it. It was worth your while. Until next week, all the best. Bye for now.